Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
As I said, reallocation 70% U.S. dollars at the moment. If people, if central banks have a fiduciary responsibility, and if they see real risk based on this explosion of debt in the U.S. economy and eating of the seed corn, we could see some reallocation. Again, not that we have to see a change in reserve currency status, but even a reallocation again away from the dollar is not only from a negative sentiment standpoint, it's real dollars that back to the supply and demand thing, moving real money moving away from the dollar. And if we saw the dollar decline again in some type of sharp dollar crisis, the U.S. wealth is hammered very, very hard. And again, that's very bad for the global economy until we start to see the consumer from someplace else start to carry more of the load than the U.S. consumer is carrying. The other real problem, and the other thing we have to watch here, is if the dollar starts to fall precipitously, it means that there's no particular reason for the Japanese or Chinese to continue to hold U.S. Treasuries, or at least their incentives start to decline, and the disincentives to hold them start to move higher. It goes back to U.S. consumer wealth. If the U.S. consumer continues in its shell and the U.S. dollar is falling off a cliff, it means the U.S. consumer is really taken off the table. One of the reasons China and Japan hold so many U.S. Treasuries, it in effect subsidizes directly, indirectly, the U.S. consumer, their major customer. If their major customer goes away, their incentive to hold U.S. Treasuries goes away, and if they start selling those babies, again, it puts even more pressure on the U.S. economy. Again, we don't see this scenario playing out at the moment because we still have the mutually assured destruction thing in place, meaning if the U.S. economy is crushed, they're not going to be buying Asian goods. So that scenario is still in play. The reality is once the Asian economies make that transition to a domestic economy, they're not necessarily going to need to hold as many treasuries as they have now. There's no reason to. They can depend more on their domestic demand than on U.S. demand. That's not necessarily a bad scenario if the U.S. consumer continues to save, and at the same time, the Asian economies open their market to the free flow of Western goods. As I said, Asia develops this consumer market and allows them to buy goods outside of their own country. Japan, of course, does it now, but China does not with their capital because of their capital controls. If they open up, we could see a demand for Western goods and some trade flow back the other way. So from that standpoint, it shouldn't be. It's not necessarily a negative thing if we see this global balancing start to take place and we start to see real consumer demand come in out of Asia. That is part and parcel of this idea of global rebalancing. It's just painful here in the midst of that, and I'll answer questions on that if you have questions later on. I know it's a bit esoteric. So in a muddle-through strategy, basically we see a resumption of the long-term dollar bear market trend. And Steve will give you some ideas how to play that. Again, the commodity currencies may continue to get juiced. The euro is really the mirror image currency. What's seen as a dollar alternative currency will continue to do well on a muddle-through strategy. Aussie higher, U.S. dollar back in that bear market. The euro, again, not because of anything of particularly great shakes going on in Europe, but the euro really plays the mirror image role of the U.S. dollar because it's the secondary alternative that gets allocation when the U.S. dollar is doing badly. The gross supply price scenario, I think I talked about this. The U.S. comes out of it before Europe does. Interest rate expectations and differentials improve for the U.S. dollar relative to Europe on this idea that the Fed would raise first and faster. What's also interesting, this trade flow to the emerging markets really is a sleeper, kind of a stealth positive for the U.S. economy. In fact, we saw that in the last quarter. We saw trade flow and very positive U.S. export numbers because of the demand for the emerging markets. The U.S. economy actually produces some high-level goods and technology and other research things that are being demanded by the emerging markets. So we had a very positive export flow last quarter even. And if we come out of it, this could be the real sleeper, the stealth sleeper that could drive GDP growth for the U.S. economy and power it past Europe in terms of from a growth surprise standpoint. So just keep an eye on U.S. exports and the continuing improvement in terms of the component of exports shifting to the emerging areas and away from the industrialized markets. Europe in general, there's big pressure building in the European Monetary Union. In fact, we did a very extensive report on the potential for the monetary union coming apart, and I think we have it listed there on the ISE website. You can download it for free. I won't go into all the factors now, but the European economy, the pressures are building because there's one currency for all those countries that are in different stages of the global business cycle, and they're basically straitjacketed. A currency fluctuates up and down and plays the role of a pressure valve often for an economy. The Europe is, not that the euro doesn't fluctuate, but a lot of the countries inside the euro have very desperate business cycles and need more currency relief than maybe some of the bigger countries may or other countries may. The European Monetary Union was set up for Germany, German industrialists, and also set up for the banking system, which is a very high component of wealth generated in Europe. And it's been bad news for a lot of the other countries that are inside it that didn't make the structural changes that the architects of the European Monetary Union had hoped. So pressure's building by the day, really, in the monetary union. So that would be another bit of pressure that we could see the U.S. from a relative basis really outperform the euro if we get this growth surprise. Again, then the play would be obviously you want to play the euro to the short side against the U.S. dollar, and in terms of the U.S. dollar-euro call components, or at least convention of the ISE, you'd be buying calls on U.S. dollar-euro, and Steve can talk to that. Here's a look at where the euro is here, and we've seen, obviously, again, there's that risk bid move in the dollar, big bounce back up, very volatile in here. And the euro now back up. A lot of people think we're going to get a test of this 147 level, and it sure looks like it. Looks like it could happen. If it gets through here again, who knows? The dollar's back into that. If the euro gets through here, it looks like the dollar tests its lows, the euro tests its highs. We find this interesting because if you look on a purchasing power parity basis, the relative value of the U.S. dollar really is around 110 to 115. And think of it this way: the euro. Germany is getting squeezed very, very hard on both sides of the fence, a falling dollar and a falling Chinese currency because it's pegged to the dollar. It's two major competitors in the world. Their currency is getting cheaper and cheaper, and Germany is under the pressure of a high currency and a decline in global demand for its goods. So it's interesting to see again, that's part of the pressure that's building in the European Monetary Union. So again, heading in some pretty stiff potential resistance in here. Very, very close, very, very important to watch. As I said earlier, we're reaching some very important technical levels. And looking on the U.S. dollar euro side of the fence in ISE terms, similar chart here, seeing the support, right in here, 68, 69 area, and it gets through test down in here.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.